Q. Knowledge of accounting concepts and practices, e.g., accrual accounting, cash accounting, etc. The syllabus emphasizes knowledge of accounting concepts and practices because reliable financial information forms the foundation for budgeting, forecasting, reporting, and strategic decision-making. Accounting concepts establish the rules and methods organizations use to record, classify, summarize, and report financial transactions. FP&A professionals rely on accurate accounting information to evaluate operational performance, conduct variance analysis, and support management decisions. Important accounting practices include accrual accounting, cash accounting, revenue recognition, matching principles, and financial statement preparation. Understanding these concepts improves financial analysis, forecasting reliability, and compliance with accounting standards. Strong accounting knowledge also strengthens communication between finance, accounting, operations, and executive management within organizations. Accrual accounting is one of the most important accounting concepts because it recognizes revenues and expenses when they are earned or incurred rather than when cash is received or paid. This method provides a more accurate representation of an organization's financial performance during a reporting period. Revenue is recognized when goods or services are delivered, while expenses are recorded when obligations arise, regardless of cash timing. Accrual accounting follows the matching principle, which aligns expenses with the revenues they help generate within the same period. Most large organizations and public companies use accrual accounting because it improves comparability, transparency, and decision usefulness for management, investors, creditors, and regulatory authorities. Cash accounting differs from accrual accounting because transactions are recorded only when cash is received or paid. Revenue is recognized when payment is collected, and expenses are recorded when cash is disbursed. This approach is simpler and easier to administer, making it common among smaller businesses and certain private organizations. However, cash accounting may not accurately reflect financial performance because timing differences between operational activity and cash movement can distort profitability and financial position. FP&A professionals must understand these limitations when analyzing historical data or preparing forecasts. While cash accounting emphasizes liquidity and cash flow management, accrual accounting generally provides a more comprehensive view of long-term operational and financial performance. Revenue recognition and expense recognition are fundamental accounting practices because they determine how financial performance is measured and reported. Revenue recognition principles establish when organizations may record sales or service income within financial statements. Modern accounting standards emphasize recognizing revenue when control of goods or services transfers to customers and performance obligations are satisfied. Expense recognition follows the matching principle by associating costs with related revenues within the same accounting period. These practices improve consistency, comparability, and reliability in financial reporting. FP&A professionals analyze revenue and expense trends carefully because recognition methods significantly affect profitability analysis, budgeting, forecasting, and strategic planning decisions within organizations. Accounting concepts also include principles such as consistency, materiality, prudence, going concern, and historical cost. Consistency requires organizations to apply accounting methods uniformly across reporting periods to improve comparability. Materiality emphasizes focusing on information significant enough to influence decisions. Prudence encourages conservative judgment when uncertainty exists, helping prevent overstated assets or earnings. The going concern principle assumes organizations will continue operating in the foreseeable future, influencing asset valuation and reporting practices. Historical cost accounting records assets at original acquisition cost rather than current market value in many situations. FP&A professionals must understand these principles because accounting assumptions influence financial statements, ratio analysis, forecasting models, and management decision-making processes. Modern accounting practices increasingly integrate technology, automation, and regulatory standards to improve reporting accuracy and operational efficiency. Enterprise resource planning systems, accounting software, and business intelligence tools automate transaction processing, reconciliations, and financial reporting activities. Accounting practices are also influenced by frameworks such as Generally Accepted Accounting Principles, GAAP, and international financial reporting standards, IFRS, which establish consistent reporting guidelines across organizations and jurisdictions. FP&A professionals use accounting information generated from these systems to support strategic analysis, performance management, and long-term planning activities. Strong understanding of accounting concepts enables finance professionals to interpret financial information accurately, strengthen forecasting reliability, improve compliance, and contribute effectively to organizational performance and sustainable value creation.